June 15, 2020 meeting of the investment meeting of the NYCERS board will now come to order. As per New York City Executive Order 103, which establishes a state of emergency due to COVID, and Chapter 56 of the laws of 2022, Part WW, adding Public Officers Law 103-A pursuant to Section 3, the board has decided that for the health and safety of all trustees, members offered an appeal of the board's medical board, appeal of the this says the medical board's determination on the public. It will implement Public Officers Law Section 103A3 and continue its meetings remotely during the state of emergency. Ms. Winery, please call the roll.
Good morning, Chair, Mayor's Office.
Here, and also joined by Shuman Ray.
Thank you. Comptroller's Office.
John Dorsett, designee for Controller Brad Lander.
Public Advocate's Office.
Elizabeth Guzman, Public Advocate Jumani Williams.
Borough President Manhattan.
Isha Sutton James, designee for Borough President Mark Levine.
Borough President Brooklyn.
Marina Lozada, designee for Borough President Antonio Reynoso.
Borough President Bronx.
Martha Camille Sabio, designee for Bronx Borough President Vanessa L. Gibson.
Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island.
Dan Master for Staten Island Borough President Vito Fosello.
International Brotherhood of Teamsters.
Ruben Torres and Julie Colby for President Gregory Floyd.
Transport Workers Union.
Dave Katzman for TWU Local 100 President Tony Otano.
And District Council 37.
Ray Santander here as designee for Executive Director Henry Garrido.
We have a quorum.
Great. I think the first thing on the agenda is the quarterly fund performance overview.
So, Phil, we're going to turn that over to Mike Haddad, the Acting Chief Investment Officer, to give us the quarterly update.
Good morning, all. Thank you, John. This morning, as you said, we're going to go through Q1 quarterly performance, which feels like ancient history. But just as a reminder, in public session, I'm going to start with a markets overview and your portfolio overview as of the end of March. Dan Haas in our risk group is going to do some risk analytics around that. We're then going to pivot into some forward-looking concerns in the marketplace. And then again, Dan is going to do some stress test scenario around a few of the different outcomes. Then we're going to switch into executive session to give you a more timely down look at performance. And we have deep dives today from fixed income. Public fixed income, we have Robert Fang, and alternative credit, we have Tina Sue. So a lot of fixed income today. Obviously, as fixed income has been the dominant theme in marketplace in not only Q1, but Q2, particularly the last couple of days. So with that being said, and then we have several investment recommendations from both BAM and your consultants. Next slide, please. Let's just jump right in as we have quite a busy day. Next slide, please. So here's the public market performance. Excuse me, let me just change my screen. Public market performance for Q1. The first column has the returns by asset classes, and you can see all red across the board. Couple things that I'd call your attention to is U.S. equities, despite a poor Q1, still have very positive returns in the longer time periods, particularly 3 and 5 year. And then if you compare that to the consultants' expectations, and just to frame what we have there, that's the average of the 5 general consultants for the city plans. You can see U.S. equities have vastly outperformed expectations. So we're going to talk about that a few different ways throughout the morning. The other thing I would call your attention to is the negative returns in fixed income. As we had a rising rate environment in Q1, and that rising rate environment continues today. Next slide, please. So what's the narrative around Q1? It's a continued rise of inflation and the central bank rate hikes. I've highlighted a few of the important dates throughout Q1. This is ongoing. We have a Fed meeting today, as you're all aware of, and expectations are centered around continued rate hikes today. So the themes in Q1 carry on to today. Adding to Q1 inflationary concerns were the events, Russia's invasion of Ukraine, as well as China's zero COVID policy. So those exogenous events have increased the inflationary pressures. And you're going to hear more about that from Robert in his comments this morning. Next slide, please. So given we have a lot of fixed income stuff today, I want to give just a couple slides on the equity market and what happened in Q1. And what we're showing here is the decline in the forward PE ratio in both the S&P 500 and the NASDAQ. As a reminder, we've talked about this for the past several years, how the valuations in the equity markets were at extremes. So what we've seen to date so far has been declines in the PE ratios. And while they've come down, which makes them less expensive, they're still relatively expensive on a historical basis. Next slide, please. Speaking of historical moves, this slide shows the unprofitable tech index. So think names like Zoom, Peloton, Teladoc. In the pandemic, this sector rose almost 4.5 times as designated by the green line to that peak about March of 21. And this index has seen a collapse of in excess of 75%, as this slide is a few days old as well. So a lot of the unprofitable tech names which have rallied have come back down again. Next slide, please. So to frame Q1 in historical perspective, what we're showing here is a histograph going back almost 50 years. Along the horizontal axis, that is the quarterly returns of a 60-40 index portfolio. And along the vertical axis is the frequency of those returns. And it results in a bell graph here. And a Q1 highlighted in that black bar on the left side here was minus 5.1%. And over the last 50 years, that was the 8th percentile of returns for that quarter. So historically, a really, really tough quarter for index portfolio. You know, we're not indexed, but we a lot of what we have certainly resembles it. Next slide, please. So that's the market. So let's get specific on NYCERS. How did your portfolio do in Q1? Here is the net public market absolute returns by strategy. And you see all red, as you would expect, given what happened in markets. Just a couple things to highlight in here. Even TIPS had a negative return as real yields rose in the quarter. And ETI, the second row to the bottom, on negative returns there as their interest rate exposure. Next slide, please. So in private markets, these are all positive returns. So a couple of caveats here. The first 4 rows here, these are all returns. I'll remind you that they're marked with a lag. So these returns are as of December 31st. Opportunistic fixed income on the bottom, which Tina's going to talk about in much greater detail, is marked 3/4 of the portfolio through Q1. So that's more current, but very strong returns here. A couple of highlights just to talk about private equity, benefited from both realization and markups. In core real estate, your portfolio benefited from portfolio construction with higher than benchmark allocations to industrials and to multifamily, and lower than benchmark allocations to hotels and some of the other sectors damaged during the pandemic. Non-core real estate benefited from some markups that were marked down during the pandemic. Infrastructure doing well, doing as expected, similar type returns. And opportunistic fixed income holding in very well. And Tina, again, greater detail on that. Next slide, please. So importantly, how has your plan done during Q1? So a lot of figures on this slide. Let me just kind of lay it out. The first 2 rows are NYCERS. The next 2 rows are BERS. And let's focus first on how your plans have done relative to your individual policy return. Both NYCERS and BERS on a 3-month and a 1-year, you've underperformed your policy return by a meaningful amount. And that is due primarily to your public equity negative excess returns, which we'll get to in a minute. So that's the bulk of the attribution there. The other two benchmarks that we like to compare ourselves to is a public market 65-35 portfolio, the second to last row. And you can see both NYCERS and BRRRRs have outperformed that benchmark. And that's due to your weightings and allocations to private markets, which we showed has outperformed public markets. Conversely, the TUX index, as a reminder, that is other large asset owners, including endowments and foundations. And we have underperformed that index, and that's because they have higher allocations to private markets and allocations to venture, which have done very well on the 3 and 1 year basis. Next slide, please. So let's go a little bit deeper into the excess return. So this is for NYCERS. The first two bars show your plan return, your policy return. The middle bar is the excess return, that's minus 75 basis points. When we disaggregate that into two components, we show the asset allocation effect of being positive 21. As a reminder, your portfolio has been slightly underweight public equities, slightly underweight public fixed income, and slightly overweight cash. That has served you well in the quarter. And the selection effect, so this is manager selection, that's an aggregate minus 96 basis points. And we're going to spend the next several slides drilling down into that one. Next slide, please. So here are public market excess returns. So just public markets, again, Q1. Top row, domestic equity. So that 3-month excess is positive 5, which doesn't on the surface show the dispersion underneath that. A couple things to point out. You benefited from your exposure to smart beta. So think research affiliates. They had a very positive quarter. You were hurt by your small cap allocation, and they underperformed the index, with Cook and Beeler being the outlier, minus 700 and change basis points. The other place you were hurt by your lack of exposure to the energy sector. The energy sector was one of the few sectors up in the first quarter. Energy was up 39%, and that cost you, just check my notes, that cost you about 50 some odd basis points in Q1. Importantly, in the first quarter, you see your excess return minus 100 basis points. Again, that was 90 of those basis points was due to no exposure to the energy sector. Next row down, World X USA. There you see some big negative numbers in the 3-month and the 1 year number, but still excess performance in the longer date. So here we were damaged by exposure to our growth managers. So specifically Bailey Gifford and Walter Scott, very, very large underperformance relative to the index. Bailey Gifford with almost twice as much negative performance, as they are in the more growthy growth part of the equity market. And when you think about that unprofitable tech index, some of those names are in Bailey's portfolio, and that's hurt. Walter Scott, also negative performance, but they focus more on what they would call quality growth. So less of an underperformance, but still meaningful. The other thing to draw your attention to, the second to last line, ETI. As a reminder, in the ETI portfolio, the duration of that portfolio is a little bit longer than the index. So when we have a rising rate environment, you would expect that to underperform as expected. Note the last row, underperformance in public markets on the 3-month and the 1 year number. Big underperformance there, and that's the crux of why you've underperformed your custom benchmark. Next slide, please. So private markets, strong excess returns in the 1 year trailing number. And as a reminder, we're showing private markets obviously with a lag, but we're also showing the shortest time frame being 1 year. And we're not focusing on the 3-month because not a lot changes quarter to quarter, and we want to look at this in 1 year increments. So private equity, we had commented that it was both realizations and markups. In private equity, you had just extraordinary returns from KKR 12, plus 70 something, EQT very strong, Platinum 5 very strong, and these are all eye-popping 70-ish kind of numbers. The other one to mention is Ardian, again, eye-popping one-year numbers. Before I leave the private equity line, I'm going to take your attention to the 10-year number. So you see negative excess return. As a reminder, in the 10-year number, that still captures the higher allocation to your runoff managers. On a 10-year basis, that's they returned almost 9%, while your primary manager is 20%. The ratio is about 20% runoff, so that still is a drag on performance in the longer dated time frame. In core real estate, you benefited from portfolio construction. So within logistics, strong performance from your Exeter. Exeter was in the high 60s. Prologis, another strong performer. And then in multifamily, Cortland, again, eye-popping numbers in the 40s and 50s. In private real estate and in opportunistic real estate, again, strong outperformance in the 1 year. European managers that benefited from markups in the portfolio included KKR, REP2, as well as Artemis. And then also in non-core, Blackstone, who you hear from later today, they have eye-popping number, again, on a 1 year basis in the 60s. Moving down another row, infrastructure, you see very strong returns across all time frames. The 1 year, we benefited from some realizations from both EQT and KKR, and those realizations came both higher than the previous marks as well as higher than previously modeled. So those realizations really drove the outperformance in infrastructure. Next slide, please. Moving on to rebalancing in Q1. So if you take your eyes to the bottom, you see $1.7 billion out of and $1.7 billion into. On the right-hand side, you'll see cash went up by $300 million. So in January, we rebalanced out of U.S. equities as we were trying to keep the weight at or around zero. We've been overweight up until Q4. So that was the only rebalancing out of the equity markets in Q1. The rest of that, the $1.4 billion and change, that was to fund 3 of your mid-cap managers. So that was just from one sleeve of equities into another. Next slide, please. And then as a reminder of your under and overweights in public markets, we're showing you the last 3 quarters, how that's moved. And you'll see the last 2 columns in here, the change from Q4 to Q1. Not much change in cash, not much change in your underweights and core fixed income. But what you will see a change is in your public equity lines. The U.S. equity line went from overweight by 1% and change to closer to neutral, and both developed markets and emerging markets, which were slightly overweight at the end of Q4, were slightly underweight going into quarter end. And again, as I showed in the previous slide, only one rebalancing trade out of equities in the beginning of January. The rest of these changes happened through movements in net asset value. So let me pause here for any questions or comments on Q1 before I turn it over to Dan for some risk analytics around Q1. Over to you, Dan.
Can you all hear me okay?
Yes.
Yeah. Okay, great. Thanks. Sorry, my just at the critical moment, my audio or my video went out, but we can ham and egg it and make sure this works through. I'll just rely on you guys for visual cues. If we look at the current slide, these are just highlights from the risk summary that appears on your quarterly reports. If we look at the top left panel, you'll note the total plan risk for the quarter ended on March 31st was 11.81%. That's up from 11.36% in December. Benchmark risk is 11.27% in March, increasing from 10.6% in December. The benchmark risk increased a little more than the portfolio risk, and we see small corresponding changes to active risk and data. If we look at the bottom panel, again, we're plotting here the ex-ante portfolio risk, the benchmark risk, and data for each of the last 12 months. The blue line there is your portfolio risk. The red line your benchmark risk, and of course those gray bars are your beta values for each of those months. Just noticing here that the projected portfolio and benchmark risk begin to tick upward in March as market volatility increased, and that's a reversal of trends that we've observed in the past. The chart at the top right breaks down the change in risk during the quarter into three broad categories. There's the change in volatility, the change in correlations, and the change in portfolio exposures. Those first two lines, the change in volatility and the change in correlations categories, are market-driven phenomena, meaning that these risks decline in step with, change in step with market risks, and were not the result of specific position weights or tilts in the portfolio. The change in portfolio exposures represents a portion of the portfolio risk that was detached from these market trends. You can see that most of the change in risk this quarter is attributed to increased market volatility rather than changes in the correlations or portfolio exposure risks. And that's a bit of a reversal from the trends, again, that we've seen in the past. And then finally, the table at the top center shows you the differences between your portfolio allocation by assets and your allocation to risk. As in quarters past, you'll note that we've allocated about 2/3 of our assets to equities. The standalone risk coming from the equity portion of your portfolio is 17.46%, and the standalone risk coming from fixed income investments is 3.95%. On a contributory basis, we see 11.02% or 93% of total risk coming from equities. And we'll elaborate on that theme a little bit on the next slide. Here, we're summarizing portfolio allocations, performance and risk by strategy as of March 31st, 2022. Looking at the leftmost section, you see a snapshot of your parking place adjusted allocations on March 31st. At that time, as Mike alluded to before, we had slight overweights to cash and private equity, and we're underweight our core fixed income strategies. The performance section in the center shows you a 1-year return by strategy relative to their benchmarks. Here we see the alternatives outperforming their benchmarks, and we show an underperform in developed markets equity again, just echoing things that Mike shared with you a few minutes ago. And then finally, we're decomposing the risk by strategy in the rightmost section. The first three columns in that section show you the portfolio risk, the benchmark risk, and the contribution to portfolio risk for each strategy. As you'll recall from the last slide, 93% of the overall risk comes from equities, and here you can see how the individual equity strategies contribute to that total. And then in the rightmost column, we're showing you the active risk or the tracking error for each of those strategies. Tracking error, by the way, reminder, is an indication of how closely the portfolio follows the index to which it's benchmarked. For context, we would expect to see almost no tracking error coming from a pure passive portfolio and its benchmark, and you'd expect to see something above 4% for actively managed funds. Along those lines, you note the tracking error is comparatively low for U.S. equities, where we're mostly in passive strategies, and then a little higher for emerging markets, where we're more invested with active managers. And then finally, as in quarters past, we see most of the tracking errors picked up through our allocations to alternative investments. Again, this is partially because of how alternative asset risk is modeled in Borrow 1, and partially because the performance benchmarks that we've assigned as a matter of policy don't faithfully respect the modeled risk attributes of the investments. That wraps up the section for today. I'm happy to take any questions you may have now, or we can turn the conversation back over to more recent trends in the portfolio.
Continue on then. So when we think about concerns going forward, it's the same set of concerns in the rearview mirror, and that is slowing growth, high inflation, rising interest rates, and the two exogenous events are still ongoing. That is the Russian-Ukrainian war, as well as events in China, which are slowing growth and contributing to rising inflation. Next slide, please. So let's drill down a little bit more in this. So we're in the midst of central bank rate hikes. It's not just the U.S., it's global. The Fed has embarked on quantitative tightening, and they've laid out a very aggressive path that's going to accelerate over the next 3 months. Last week, the ECB announced the end of their QE, and they are anticipated to raise rates in the second half of the year as well. At the same time, we have rising inflation, rising commodity prices, and this is leading to forecasts of slower growth, with near-term inflation forecasts higher and longer-term inflation supposed to come down. So importantly, the debate in markets, recession or soft landing, major implications for future asset classes, and to try and frame that discussion, we're gonna frame it in two ways and think about monetary policy, whether it has to get to neutral. Is that sufficient to slow inflation, or does it have to get to restrictive? And we're also thinking about financial conditions. On that neutral or restrictive question, so in monetary policy speak, neutral would be the policy rate that neither stimulates nor slows the economy. And most market participants think neutral has to be at a minimum zero real rates as defined by inflation minus the policy rate. And restrictive is that has to be somewhere about 2% higher than that. So as we think about neutral or restrictive, kind of bear that in mind. And financial conditions is another way to look at that. So let's dive in. Next slide, please. So this slide shows how market consensus has changed on slowing growth and rise in inflation over the past year. So this was consensus. You can see the dark blue line is slowing growth throughout the year, still positive. Bear that in mind. That gets into that recession or soft landing question, while actual inflation and expectations have risen throughout the year. Next slide, please. So this is important. How growth translates into equity concerns are extremely important. GDP growth is probably the single strongest contributor to earnings growth. And the slide on the left shows earnings growth over the past few decades. The blue bars on the right side of this are consensus analyst earnings. And importantly, you see increasing earnings estimates going forward. That's in line with a soft landing view that GDP will continue to grow and thus earnings will continue to grow. If you look back in history, those green bars show what's labeled in this graph an earnings recession, and that's defined as earnings being lower than the previous peak. And you can see over the past few decades, we've had a handful of different episodes where earnings have decelerated over a number of years. So importantly, if we are going to go into a recession, that likely means that by definition, negative GDP growth, and those blue bars probably have to come down, and that's obviously going to impact the equity market if we're going to have negative GDP growth. How does that translate into today? On the right-hand side, we're decomposing S&P returns for this calendar year. The green line shows the S&P return, and this is obviously dated by a few weeks, around minus 13%. And importantly, despite negative return in the equity market, the gray line shows positive return in earnings. So earnings growth has been positive year to date. So why do we have a negative return in equities? Again, that's because of the multiple growth. The price earnings multiple has contracted through this year, and that's down almost 19%. And that kind of ties into some of those multiple graphs that we showed earlier in the presentation. So again, this is important when we think about the recession or soft landing and what happens to earnings. Next slide, please. Importantly, historically, how has recessions impacted equity markets? This slide shows since the end of World War II, 12 separate recessions, and the equity drops from peak during each of those instances. The blue dotted line across shows the median over these 12 episodes, minus 24%. Coincidentally, that's about where we were as of today, as of yesterday, minus 22% from peak, but a lot of dispersion around that number, and that speaks to the depth of the recession. And with the greater the recession, the greater the drawdown. So this gets into, again, recession or soft landing, and whether or not we've had a big enough drawdown in the equity market that reflects that. And just a reminder, as we started the year and the equity market was at its all-time high, how high those valuations were. So, peak to trough, certainly valuations have a lot to do with that. Next slide, please. On the inflation question, Friday really upset the narrative that inflation had peaked and was on its way down. We made new highs in headline inflation. So let's think about some of the inflation fundamentals going forward. On the left-hand side, we're showing a slide that the contributions to core PCE inflation from the supply-constrained categories. The list of those categories is inside that box. The dark line on the graph shows the sum of those different parts and how those supply-constrained items have really added to core inflation. As these supply constraints become loosened up, we expect these contributions to come down and actually turn negative starting into 2023, and this will help alleviate some of the inflationary pressures in the economy. Conversely, on the right-hand side, what we labeled this rising OER inflation. OER stands for owner's equivalent rent, and that is roughly a third of core inflation in the CPI data. And what this slide shows, the dark line is the model on this slide, and the model takes into account a handful of different inputs, importantly home prices, importantly some real-time rent data, and that X marks where we are now in the actual OER component. So OER is expected to be increasing inflation going forward, and we saw that last Friday with that number being higher than expected and adding to the upward pressure on inflation. So two different vectors here on inflation, and how that unfolds is going to be critically important to that question of neutral or restrictive policy. Next slide, please. The labor market obviously has important components on inflation as well. Two concerning graphs on this slide. On the left is the Atlanta Fed wage index. This is widely regarded as a good index for how wages are doing. And you can see here wages are up almost 6%. So that is adding to the inflationary pressures in the job market. As well, on the right-hand side, we're showing here the number of job openings versus the number of unemployed. It's almost twice as many of job openings as there are available labor. So that would argue for continued inflationary pressures in the labor market as well. Next slide, please. Inflation expectations also play an important role in inflation dynamics. So good news, bad news in both of these graphs. Inflation expectations, there's no go-to measure in the Fed or the market's mind. So I'm showing two here. On the left is the New York Fed Inflation Index. So the bad news is the inflation expectations are on a 1, 3, and 5 year, as designated by the colors, are still high. The good news is in this survey, inflation is expected to come down over time. So that's the good news in this slide. Same on the right-hand side. The red, this is the University of Michigan inflation expectations, a longer time series here. The red line is the 1 year inflation expectations. The blue line is the longer dated, the 5 to 10 year. Again, the good news is the participants here expect inflation to come down. The bad news here is how high the 1 year is. And importantly, the blue line, that data came out Friday as well. That the 5 to 10 year came out at 3.3%. And as you can see, that's a new high for this series going back over the past 12 years. And that added to the upward move in yields on Friday and Monday. Next slide, please. So the neutral or restrictive monetary policy, to help frame this, what we're showing on the left is the real funds rate. Again, CPI minus the actual funds rate, showing two different lines here. The dark blue line is the headline CPI. The lighter colored line is core CPI. You see very negative numbers here because it's taken into account where the funds rate is today. And the midpoint of the funds rate today is less than 1%. It's 0.875. So you can see there's a lot of work to get this line up to neutral, which is a zero real funds rate. So again, this calls into mind the two different vectors. So we have inflation expected to come down, the funds rate expected to come up, and where they meet somewhere around zero is important to the market. On the right-hand side, we're showing where currently the market anticipates the funds rate to go. And this is best depicted by June 23 Fed funds futures. I had to update this slide because it moved so much over the past couple of days. So that this This has moved higher in the past few days by almost 75 basis points. So prior to Friday, the market was anticipating a terminal funds rate slightly above 3%. Today, the market anticipates a terminal funds rate somewhere around 4%. That's depicted by 96, the figure in this graph. And so what the market expects today is inflation to come down to somewhere near 4, the funds rate to get somewhere near 4%, and that gives you a zero real rate, and that would be a neutral monetary policy. If we have to get to restrictive, that's got to be positive. So how do you get to positive real rates? Either the funds rate's got to be higher inflation, or inflation has to come down more than what's priced in. And it's this neutral restrictive, which I think the markets are going to wrestle with over the next several months. Next slide, please. The second way to think about the movement in markets is a financial conditions index. So the theory is monetary policy impacts the economy through financial markets. Said differently, movement in the funds rate. So moving the funds rate from 0.875 higher today, that really doesn't do much in and of itself, but it's how it impacts other markets. The key variables in FCI are the equity market, long-term and short-term interest rates, the value of the dollar, and credit spreads. And so the graph on the right shows FCI going back a few years. And what I would draw your attention to is where we are today relative to where we are pre-pandemic, and that's about in the middle part of that graph before it trended higher. So financial conditions are tighter today than where they were pre-pandemic, so that's important. So that, relatively speaking, the movement in spot rates and forward rates have actually slowed FCI, so that should help slow the economy and slow inflation. The question is it enough or not? And again, this is what markets have to wrestle with over the next several months. Next slide, please. So what we're showing here is a long-dated slide going back to 1900, obviously. And this is to frame on a longer-term basis where we are historically in valuations. The blue line is the Cape-Shiller price-earnings ratio. And as a reminder, this is inflation adjusted. So this still shows the equity market as extraordinarily expensive given the high level of inflation. The orange line shows the U.S. 10-year yield, again, on a long-term basis. And even though we've moved up in yield, 300 some odd basis points from the low, on a historical basis, the 10-year yield is still extraordinarily low. Again, a lot of things have changed over the last 120 years, but again, just kind of wanted to frame that. Next slide, please. And this is the one that should keep us, this is one we all have to be concerned about. So what we're showing here, again, the same long time frame, and in the, we're showing the potential for the lost decade of returns. And the shaded areas are the 4 decades plus where we've had zero returns on an index portfolio of 60% equities, 40% stocks. Importantly, every one of these lost decades have come after a time period of very strong returns, which we've experienced over the past decade coming out of the global financial crisis. So if we are in a higher inflation regime, interest rates are going to be higher. That's going to impact equities and bond performances going forward. We've seen the negative returns that we've had in Q1, and we're going to show you an updated view on how the portfolio is done when we go in executive session. But this is the thing that should keep us all up at night. So that concludes my comments going forward. Dan has some stress tests around this recession or soft landing. So let me pause here for any questions or comments before we turn it over to Dan to walk us through the stress test.
Question, Mike. Ray Santander. How are you?
Good morning, Ray. I'm worried, but I'm well, thank you. And you?
Thank. So, first quarter GDP growth was negative. Is that correct?
Yes.
So, if second quarter growth is negative, which it may be, and it's only a few days left, 2 consecutive quarters of negative GDP growth is by definition a recession, is it not?
Yes.
So I guess the issue, is it soft recession, hard? I mean, how would we frame that? Soft recession, hard recession?
Well, I would remind you Q1 GDP, to your point, was negative, but when you look at the components of GDP, consumption was strong. Consumption was 3.5%. So how, with 2/3 of the economy being positive, how do we print a negative number? I know you know the answer to this. The net trade was subtracted 3.5% because imports were stronger than exports. The imports speak to the strength of the domestic economy versus the weakness globally. The second part, inventory build, was negative in the quarter, so that took away some of the growth. Importantly, Q2 expectations are somewhere in the vicinity of plus 3%. Q3 similar. So I think there were some special factors that hurt Q1, and I don't think the market expects a recession in near term. If we do get a recession, it's expected sometime in the second half of 23 as the rate hikes take hold, as the loss of wealth from the equity market contraction, the collapse in crypto, the collapse in some of the speculative excesses of the markets, as that takes hold and slows consumption, I think concerns and are for the, a year-ish for the recession. So I don't think it's a near-term concern. I think it's later as the rate hikes take hold.
Thank you, Mike.
Sure.
Okay. Why don't we move on to the next slide, and we'll talk through these stress scenarios. Excuse me. Just by way of reminder, this is meant to be a thought experiment that frames the direction and general magnitude of the portfolio response to these broad macro inputs. We started, as in the past, with MSCI research published back in April, and then your new Chief Risk Officer, Ed Berman, Mike, and I kind of modified those a bit to reflect more recent events in the markets. I should mention that we did this a few weeks ago, so in the moving world we're in right now, even these are a bit dated. At any rate, jumping in, we have 3 scenarios for you this quarter, and again, we're trying to frame the market's reaction function to this lower growth inflationary environment that Mike laid out for you in the last few slides. We have a base case scenario, which we see as perhaps the most likely outcome. Here, we're assuming the Federal Reserve is successful in guiding the economy to a gentle slowdown. GDP growth is slowing with a possible quarter or two of negative growth. Inflation is moderating, leading to a bull steepening of the curve. Equity markets are soft, and there's some pressure on credit spreads. Importantly, this scenario assumes there are no negative geopolitical shocks. We then have a negative scenario, a less likely but still significant outcome, where we assume markets enter a prolonged recession. Possible negative shocks here may include a Fed policy mistake, a renewed or increased geopolitical tensions, reemergence of COVID, causing, again, lockdowns and reduced economic activity. And then perhaps we see some fiscal and monetary tightening in China. Under this scenario, inflation is accelerating, driven by supply constraints, which leads to bear flattening and negative pressure on the stock market. We also see credit spreads widen and commodities rally. And then finally, we have a market positive scenario, which could be driven by surprises like China removing COVID restrictions and providing fiscal or monetary stimulus, or maybe a successful resolution of the Russia-Ukraine war. Here, inflation is receding due to the easing of supply constraints and an increase in the supply of commodities. Asset prices under this scenario rally. The rate curve steepens a bit. Pardon me. Credit spreads tighten, and then you see commodity prices declining. Given these assumptions, we can share the results on the next slide. And next. Here, we're showing the predicted returns for each of the scenarios for both for the overall portfolio and for strategies within the portfolio. Each scenario is represented by a different colored bar, and the resulting predicted change in value is, of course, plotted along the horizontal axis. Total portfolio level, you can see the results change from an 8.6% increase under the positive surprise scenario to a 14.7% decline in that recession scenario. In the negative scenarios, you can see more defensive strategies like tips and core fixed income mitigating losses. You may also notice that international markets sell off more extremely than U.S. as they're historically more volatile. Similarly, you see private equity showing sharper declines than public equity classes. Again, this is a function of how private equity is modeled in Bar 1, which is an important concept here. A model is naive to the speed of recovery from a market shock. A model can't speak to the skill of our managers in navigating challenging market conditions or repositioning their portfolios to take advantage of new market regimes. So in a V-shaped recovery, as an example like we saw during COVID, the fundamental valuation metrics used by our private equity managers never suffered much, and the portfolio response to the economic stressors was muted. As a result, we saw private equity performing quite well through COVID, even though these models predicted a large drawdown. However, to the extent that these macroeconomic headwinds persist, there's increased risk that more extreme valuation pressures predicted by these models will come to be. And that idea certainly lends to the lost decade concept that I shared with you a few minutes ago. I'll leave you there. I'm glad to address any questions you have now, or we can move into executive session where Mike will take you through our preliminary returns through a few days ago, and you'll hear some strategy deep dives from Robert and Tina.
Hey, Dan, it's Russ Buckley. I have one quick question for you on this chart, if I may.
Sure.
How do the various asset class correlations play into this modeling, if at all? Because I can't help but notice that the only red bar on the right-hand side is tips. Everything else is dropping, seemingly correlated.
Right. So tips actually, in that scenario, would have a negative correlation to the other asset classes, or so you'd see it as a diversifier. So when the other valuations saw negative pressure, tips actually went up. As this was modeled, that really has more to do with the fact that we stressed our break-even rate specifically, and one of the assumptions in that scenario was that inflationary pressures increase. But that is the idea behind it.
I guess I'm just wondering, I know that there's not like a perfect necessarily one-to-one correlation between equities and private equity and private real estate. And obviously the OFI infrastructure, some of those alternative assets seem to have lower correlations to some of the negative red bars in the recession. But the private equity bar seems pretty well aligned from a correlation perspective with a drawdown in the U.S. equity markets as potentially forecasted in this recession scenario. I guess I'm just surprised by that because I'm thinking of the capital market expectations having a lower than one-to-one correlation between the private equity markets and U.S. equity markets, theoretically providing some protection.
Yeah, I think I follow you, Russell. So the magnitude and direction by which these bars will move is a function of two things. Part of it is correlation, certainly, and the other part of it has to do with the volatility shown in that particular equity class. So if we're looking at an example like comparing private equity to U.S. equities, there's a relatively high correlation between those two asset classes, meaning that their prices tend to move more in tandem than if you were to compare, for instance, U.S. equities to core fixed income. The reason that in this instance that private equity you tend to see greater drawdowns than for U.S. equities is because the model predicts more volatility for private equity, and that has to do with when we feed our private equity investments through the model, it assumes that there's a higher level of leverage, for instance, in the private equity book than in the public equity book, and it implies a higher overall volatility for that asset class.
Okay, that's generally helpful. I probably need to review my capital market expectations.
Fair enough. Excuse me. Maybe we can help disaggregate the inputs to this and show you those broken out. If you'd like us to follow up on that, I certainly can.
Sure, sounds good.
Okay.
So if there's no other questions for the public session, I would make a motion to enter into executive session so that we could go more in depth on certain managers.
I will second that.
So it's been made and seconded. If there's no objections, we will go into executive session and would ask members of the public, BAM interns, any interns that are on to please exit this session. And thank you. So Melanie, if you would lead us with the report out.
Yes. The board agreed to commit funds to 1 private equity investment, 2 real estate investment, made decisions on 2 real estate matters, and 1 alternative credit investment. The details of these transactions will be released at a later date.
So with that, I'd like to make a motion to adjourn.
I'll second.
John Doris's favorite motion.
Thank you, Ron. So all those in favor? Aye. Of course, aye.
Aye.
All right. Thanks, everybody, and have a wonderful rest of your afternoon.